The news cycle is pretty much doom and gloom these days. Inflation is painful, and now economists are warning us of a recession. What's a girl to do to make ends meet? Currently, about 1 in 5 people have taken a loan from their 401k, and it's something that we get asked about all the time. So let's talk through taking a loan from your retirement plan. To begin with, you may or may not be able to take a loan from your 401k. It is completely up to your employer if they allow loans, how many, and how often you can take them. If they do allow for loans, the IRS has set a limit of 50% of your account balance or $50,000. The number one reason people take loans from their 401k is to cover a financial emergency, and that's really how they should be used. Borrowing from your retirement account should be considered for unexpected and immediate needs. You don't want to treat it like a revolving line of credit. So let's frame this discussion as though you have an unexpected expense that you have to cover. You don't have an emergency savings account. You have to borrow the money, and you have to pay interest to someone for it. Have you looked into a home equity line of credit? What is that rate? Would a local bank extend you a personal loan? And how do those interest rates compare? 401k loans can be convenient. There's minimal cost to establish. They don't show up on your credit report. They're relatively quick and easy. And the best part is you are paying yourself back the interest. In reality, it's not someone lending you money. It's the ability to access your retirement savings early and potentially penalty and tax-free. Take, for instance, a $10,000 401k loan with a 7% interest rate and a 5-year payback period. That creates a monthly payment of right at $200 that's deducted straight from your paycheck. Over the life of the loan, the total interest paid is about $1,900, which you pocket in your 401k. Compared to credit card debt or a payday loan, not a bad deal. However, there are some hidden costs you want to consider. Yes, you are paying yourself the interest, but there's an opportunity cost associated with that money. If you pull $10,000 from your retirement account that was invested in the market, then you are losing out on what it could have earned, which means you can't totally ignore market returns when talking about 401k loans. Relative to this year, a 7% return is actually favorable to a 20% loss in the market. Or maybe you got really nervous and moved your balance to a guaranteed fund that's only earning 2%. Again, a 7% interest payment may be favorable. However, most borrowers take years to pay back their loans, and most 401k participants are actually invested in the market. So if we were to generalize and could assume that you spent 5 years paying back this loan using a well-diversified portfolio, you would actually miss out on some market return. Bottom line, before your advisor says, absolutely don't do it, they may want to actually look at how your account is invested and how long you're going to take to pay back this loan. And then there's the debate over paying taxes twice. Yes, technically speaking, you are paying tax twice on the loan, but it's not the whole loan like most people think. Really, only the interest is taxed twice. It's paid back with after-tax money, and it's taxed again when you take it out. So in our previous example, you would have paid tax twice on the $1,900 in interest. Of course, all of these potential benefits completely blow up if for any reason you leave employment. You basically have until you file your taxes the next year to pay back your loan, or it's treated as an early withdrawal, which may be taxed and have a 10% penalty. No bueno. This is a risk you must understand prior to taking a loan. All right. You've vetted all of your options and determined the most convenient and low-cost way to access your money is via a 401k loan. Now what? Number one, don't stop or lower your contributions. When it comes to 401k loans, this is where most participants mess up. If taking this loan out causes you to slow down your retirement savings, then it's a double whammy and likely to cost you more than if you had just gone somewhere else and left your savings rate alone. Also, hello, you don't want to miss out on your employer match. Number 2, aggressively pay it off. Just because you have a five-year payback period, it doesn't mean you should take that long. Generally, there is no prepayment penalty on a 401k loan. So treat it like other loans and keep adding pops of extra money to it. Number 3, finally, once it's paid off, increase your contribution to your 401k to match the loan payment. You're used to making that payment from your paycheck anyway, might as well keep it ongoing. And number 4, don't take out another loan. Remember, they can be good alternatives for unexpected and immediate expenses, but your 401k should not be treated like a line of credit. That's it for this week. This is Jeannie Sutton, the 401k lady.